Good afternoon, everybody. Tom Smith from TradeMONSTER. Thanks for joining us today on another educational webinar. Today we have Chuck Hughes. Chuck is going to be going over some of the sector trading. And if I'm correct, Chuck, you with us?
Yes. Can you hear me, Tom?
You sound great. I know that this is a complete new set of tools and presentation you're going to be providing here. I'm pretty excited to see it. Those of you that have questions regarding this particular webinar, if you'd like to see it, Chuck allows us to archive these. So go to mytrademonster.com tomorrow morning. We'll have it listed right here under the month of March, and you could download it, play it back as many times as you like. In the meantime, Chuck, I'm going to go ahead and pass the reins to you, and we can get started here.
Okay, sounds good.
And for those of you that do have questions today, feel free to ask the questions in the question and chat area. We'll try and address them as quickly as possible. We have you up, Chuck. I could see it.
Okay, good. Good afternoon, everybody. This is Chuck Hughes here. I want to thank Tom for setting up these educational webinars. I enjoy doing them. And today we're going to talk about sector trading. I've been using the sector trading strategy for many years. And this strategy is good in any type of market because there's always a bull market and there's always a bear market out there that you can take advantage of. So I'm going to show you the tools I use today to select these sector trades and how I able to get a low risk entry point when I purchase an option, an ETF option. And we'll go through that trade process, and I'll show you how to profit trading options in these various sectors. Okay, so today we'll look at trading the strongest market sectors, and I'll show you a great website where you can go and instantly see the strongest sectors. It's updated daily, and it's a great starting point for sector trading. And we're going to look at participating in these sectors using high accuracy ETF option trade selection, and I'll show you the simple steps we take to set up an option trade for these sectors. And I'm also going to show you my copies of my 2 retirement accounts, and right now in the sector trading I have over $440,000 in open trade profits, so this strategy's been working well this year. And I've also got some sector trades that you can take tomorrow. These are setting up pretty well. We've had a recent sell-off, and I'm going to show you the process we use to set up these trades and show you some trades that you can take tomorrow. And then, as Tom said, we'll have a question and answer session at the end. So in my retirement accounts, I trade a portfolio of stocks and stock options, and then I also trade ETFs and ETF options in the strongest market sectors. So this has worked out pretty well. And again, I'll show you the my current real-time results. This is the daily price movement of the volatility index, the VIX. And just to show you the current market environment we're in, every one of these spikes in the VIX, of course, is a market sell-off. So the question is, how do you profit in this kind of market where you continually have these sell-offs? And you'll see that by buying the strongest sectors, you can profit in this kind of market volatility, and it's a good strategy to employ with the current market conditions. So one of the best ways to profit in any type of market is to trade sectors, and the goal of the sector strategy is to invest in the strongest sectors with ETFs and ETF options. And we take long positions in the strongest sectors, and then we take short positions in the weakest sectors. And this works in both bull and bear markets. the last two severe bear markets we had mostly short positions in equities, commodities, currencies, and it worked out really well for us. So we're trading, taking long positions in these strong sectors and taking short positions in the weak sectors. So what I'm going to show now is just some examples of a bear market and a bull market that's occurring right now. And these price charts are over the same time period. So you can see from these price charts that there's always a bull market and there's always a bear market somewhere. First example here is the Brazil index. You can see that's in a bear market. And this bottom price chart here is of the internet index. So you can see the internet index is in a strong bull market at the same time the Brazil market is in a strong bear market. Here's another example. I have the China ETF on top, and on the bottom here you can see there's a strong bull market in the coffee index. Here's another example, emerging market Europe, and you can see a very strong bull market in the Italy ETF. Here's another example, severe bear market. This is in the Trackers China Fund, and the bottom one here is the Clean Energy ETF. So again, you can see there's always a bear market and there's always a bull market somewhere. Here's one more example. This is the BRIC index, Brazil, Russia, India, and China in a bear market, and the bottom price chart here is of the Egypt ETF. So again, another strong bear market and another strong bull market. Now I'm going back in time. I've been using this sector strategy for many years, and I was trading during the bear market in 2002, and I had both short and long positions, but you can just see this is back in 2002. This was a very severe bear market. The S&P lost more than 50% of its value, and the top price chart here is of the S&P, and the bottom price chart over the same time period is the real estate ETF. So you can see, even though we were in a bear market for the S&P and the broad market, this real estate sector actually performed pretty well during that severe bear market. Here's another example during that bear market, the S&P versus the corporate bond index. So you can see corporate bonds, treasury bonds were in a bull mode during the stock bear market. And this is 2011, and we can see during this time period in 2011, bear market in the S&P in the top price chart, bull market in the 7 to 10 year Treasury bond fund over the same time period. So we want to take advantages of these bull and bear markets that occur all the time. So this is a great website to start, etfscreen.com. And what this does is it lists the ETFs based on their relative strength over the past year. And you can see the top ETF here has a relative strength of 99.3. So that's the top ETF, and then it goes down from there, 99.2, 98.8, et cetera. So if you go to the bottom of this screen, you can see the ETFs with the lowest relative strength. This one has 7.4, 5.8, 1.7. And the really neat thing about this website is it's color-coded. So the ETFs with the highest relative strength are in dark green, and then the shades of green goes down until you get to the lowest ranked relative strength, and then it becomes white. And I actually own 4 of the ETFs, these 4 ETFs, when I took this screenshot of the relative strength. And I still own these ETFs. They're still performing well. So just log on to etfscreen.com, click the relative strength trends, and it'll display these the relative strength of these various ETFs. And this is updated so that you get the latest information on relative strength. So let's look at some of the ETFs I own now. One of the ones that's been performing well over the past year is the Internet ETF, and that currently has, that's the symbol FDN right here, that currently has a relative strength of 95.4. And here's a price chart of the Internet ETF symbol FDN. And right now, it seems like Wall Street is rewarding companies that have high top-line growth, revenue growth. So I found that these companies that have good revenue growth, growth stocks, a lot of them are in these ETFs with high relative strength. And just as an example, the Internet ETF contains stocks such as Google, Amazon, Facebook, eBay, Priceline, Salesforce, Netflix, and LinkedIn. So these are typically the companies that have high sales growth, and they're performing well right now, and Wall Street is rewarding these types of companies. Here's another ETF I own, the biotech ETF. Right now that has a relative strength of 98.1. That's been performing well over the past year. Here's a price chart of the biotech ETF symbol IBB, and here's the top 10 components in that ETF. Again, these are companies with high revenue growth rates, and they're performing well in the current market conditions. Biogen, Gilead, Amgen, Regeneron, Celgene, Illumina, Alexion, Mylan, Vertex, and BioMarin. So those are the top 10 components in this biotech ETF. Here's another one, the social media ETF, and that currently has a relative strength reading of 94.3. And price chart for social media. And here's some of the components: Tencent Holdings, that's a Chinese social media stock, Facebook, Sina, LinkedIn, Twitter, Groupon, Yandex. So these are the type of stocks that have been performing well, and that's reflected in their sector relative strength. So these are the sectors we want to focus on. And one of the advantages of this sector trading is that it can reduce the risk and volatility compared to just owning an individual stock. So when you have a group of these stocks, a lot of times a stock will take a big hit one day over earnings or other different types of announcements that can really drive the stock down hard. But I noticed that a lot of times, even though an individual stock, one of the major stocks in the ETF, is down big, the ETF can still be up for the day. So that can help reduce the risk and volatility of owning individual stocks. And I got a couple of examples here. On January 7th, Netflix was down 20 points, and that's a big component of the Internet Index, and that index was actually up 1.5% that day. So even though Netflix was down 20%, the ETF was up 1.5%. Here's another example. This is on February 7th, LinkedIn down $13, and the Internet Index was actually up 2% the same day. Here's another example. This is Twitter, down 15 points, which is 24%. And the social media ETF was actually up slightly that day. So even though Twitter is a big component of that, it was down 24%. The ETF was up slightly. So you can see that owning these ETFs helps reduce that volatility that you have with individual stocks. So now let's take a look at how we can trade options on these sectors. And I've been using a 3-step process to select these ETF options, and it's worked out very well over the years. And it's a very simple process. We want to select a sector with a high relative strength if we're looking to take a long position. And then the second step is we want to use the Keltner channels to select a low-risk entry point to purchase that option. And then step 3 is we want to use what I call the 1% rule to select the option strike price with a high probability of success. And I'll show you how to do that here in a minute. So this high accuracy option trading process allows us to purchase options in these strong sectors, and this has worked out very well over the years. And I'll show you some actual examples of these trades and how they've worked out this year. Let's just talk about the risk of owning options in general. And options, of course, are leveraged compared to owning a stock or an ETF, and they provide more profit potential compared to ETF or stock investing. But at the same time, that leverage also incurs more risk. So to show you an example of that, this is a option price chain for Home Depot stock. And at the time, Home Depot stock was trading at 77.73. And you can see the call options that expired in 67 days. The at-the-money call option would have been the 77.5. And that was trading a bid of 320, ask of 330. So if you were to purchase the at-the-money call option for Home Depot that expires in 67 days, you would have paid about 325 for it. So what I did is I used the call option purchase calculator, and I input the price of Home Depot stock, 77.73. The strike price was 77.5, and the premium was 325. And the call option purchase calculator will calculate the profit potential for this option purchase, and it assumes various price changes in Home Depot stock at option expiration. In this example, from a 10% increase in the stock to a 20% decline in the stock. And so it will calculate the profit potential. This bottom row has the percent return potential for this option purchase, assuming various price changes in the underlying stock at option expiration. And we can see that if Home Depot stock remains flat, we'll incur a 92% loss. And any decrease in the stock, we would incur a 100% loss. So this just points out the risk involved when you're buying options, and you're always risking 100% every time you buy an option. So what we're trying to do with our option trade selection process is to reduce this risk tremendously, and I'll show you how we do that. So trading options can easily result in 100% loss, and the goal of this high accuracy option trading is to avoid large losses, which can knock you out of the game. And again, here's that daily price chart for the VIX Index, and again, you can see each one of these spikes here is a market sell-off. So the timing becomes pretty important. When you're trading options in a market like this, if your timing's off a little bit, you can easily incur 100% loss. So what we want to try to do is avoid these big losses that can really wipe out your account. And I'll show you how we do that. So we want to purchase call options on ETFs with high relative strength. And of course, we want to purchase put options on ETFs with low relative strength. And again, this sector strategy works in both bull and bear markets and was very profitable during the last two severe bear markets in 2008 and 2002. Okay, so once we select a sector that has a high relative strength, step two is we want to select a low risk entry point using the Keltner channels, and I'll show you how we do that. This is a daily price chart of the Dow Jones Internet Index, and you can see it's had a huge move over the past year. So the question becomes, if you want to participate in this move, where do you enter an option trade that's low risk, considering that this ETF has already made a huge move? So what I use to time my entries are the Keltner channels, and we can see the Keltner channels are overlaid the daily price movement. The vertical lines here are the daily price movement of the Internet Index, and this top blue line is the upper Keltner channel. The middle dotted line is the middle Keltner channel, and the lower blue line is the lower Keltner channel. And the Keltner channels act as a oversold, overbought indicator, very helpful when you're trying to enter a trade with low risk. And again, we can see the ETF has already made a huge move. So the question is, where do you enter? This is in a strong bull market, obviously, but you want to get a low risk entry point. So you can see that when the stock price is trading down towards this lower Keltner channel, there's usually a rally. This is an indication when it's trading at the middle to lower channel that the ETF is becoming oversold. So we can see oversold rally, oversold rally, oversold rally, oversold rally. So it's been repeating that pattern. And right in here on February 3rd, we can see the ETF was trading down near this lower Keltner channel. So I went ahead and bought 6 of the 45 strike calls that day, right there, as it was becoming, the ETF was becoming oversold. So I actually added to my position. I like to buy my options in increments to spread out the risk. So I was actually adding to my position when the ETF became oversold right here. And my brokerage confirmation shows I bought 6 of the 45 calls at 14.20. And then we can see that that was a low risk entry. ETF was oversold, and it didn't retrace very much from this entry price. So this the Keltner channels allowed me to get a low risk entry in this example. And that 45 call that I purchased for 14.20 is currently trading at 18.90, so I have a 33% return in that option. Here's another example. This is the biotech ETF, and again, we can see this has made a huge move over the past year. So I'm always looking for low risk entries. I already owned the ETF, but when it sold off here, and this was February 3rd, it sold off, got down near that lower Keltner channel, so I bought an additional option, and I bought the 190 strike call at 52.40. And again, you can see that allowed me to get a low risk entry as the ETF didn't really retrace much from that entry point. And we can see the Keltner channels again help us with the timing of our trades. We can see the ETF is getting overbought here. It was actually trading above the upward channel. Then it retraced, got down around this lower channel, got oversold, and then rallied, sold off, rallied. So this is a great tool to use to help us in our option trades. And this IBB 190 strike call is currently trading at 73.20, so I have a 40% return in this trade. Here's another example. This is the healthcare sector ETF, symbol XLV, and on January 27th, it tipped down towards that lower Keltner channel. I already owned the ETF, already had options, but I added to my positions when it sold off here, and again, this turned into a profitable trade because I was able to get a lower risk entry. So I bought the 45 strike calls at 10.82. They're trading at 14.95, so I got about a 38% return on this option. And here's one more. This is the Europe Small Cap Dividend Fund, symbol DFE. And again, this has made a huge move. And the question is, where do you want to enter this after such a big move? And again, on January 30th, the ETF traded towards that lower Keltner channel, became oversold, and I bought 6 of the May 50 strike calls right here. And again, this is rallied after my buy point. So step 2 of our process is we want to find a low risk entry point for these option purchases, and we can actually get in on ETFs that have already made a big move if we use this indicator to help us find a good entry point. And step 3 is to use what I call the 1% rule to select an option strike price with a high probability of success. And I'll show you how we do that. Once you select an ETF that you want to buy, there can be hundreds of strike prices to choose from. So selecting a strike price for the option is just as challenging as selecting the trade itself. So this is a big part of your option purchase, is selecting the strike price. So I use a very simple rule of thumb I call the 1% rule, and I'll show you how that works. And in general, when you buy an at the money or out of the money call, that will result in 100% loss if the underlying ETF is flat or it's down slightly at option expiration. So buying at the money or out of the money calls requires that the stock make a fairly good move up to the upside in order for it to be profitable. If the stock's flat or down at all, then you're going to experience 100% loss, as we saw in that Home Depot example. So this is what you're always facing when you're purchasing options. And option premiums consist of time value and intrinsic value, and options lose all time value at expiration. So when you buy an option, you're buying a decaying asset, so you always want to keep that in mind. And due to the time decay characteristics of options, when you're buying an option, we want to minimize the time value, because that decays to 0, and we want to maximize the intrinsic value. So what I use is what I call the 1% rule, and we want to limit the time value portion of that option to less than 1% of the ETF price per month. And this will allow us to minimize time value and maximize intrinsic value. So as an example, if you were going to purchase a 1-month option on an ETF that was trading at 100, you want to limit the time value of that option to 1 point or less, which is 1% of the 100 price of the ETF. And if you're purchasing a 2-month option and the ETF is trading at 100, then you want to limit the time value to 2 points. So if you limit the time value to 1% of the ETF price, then the ETF only has to increase 1% in price in order for that trade to break even and to start the profit. This has a much higher probability of being profitable than if you selected an option strike price that requires, let's say, a 6 to 10% increase in the price of the underlying ETF to break even. So obviously, if the ETF only has to move 1% to break even and start profiting compared to a 6 to 10% move, then you have a much higher probability of that trade working out. So let's look at some actual examples of this 1% rule and how I used that when I was selecting the strike price. And we saw where I bought the Internet Index Symbol FDN. I bought the 45 strike call at 14.20. And at the time, FDN was trading at 58.81. So I input the stock price at the time of purchase. I purchased the 45 strike call, and the premium was 14.20. So again, with the call option purchase calculator, this will calculate the profit potential, assuming various price changes for FDN at option expiration, in this example, from a 20% increase to a 10% decline. And this call option purchase calculator also will calculate the time value and the intrinsic value. So in this purchase that I made, we saw that the stock was trading at 58.81 and purchased the 45 strike call at 14.20. So the time value portion of this option was 39 cents, and the intrinsic value was 13.81. So you can see that this allowed me, this in-the-money option allowed me to minimize the time value, which is only 39 cents in this example, and I maximize the intrinsic value, which is 13.81 in this example. So we want to select in-the-money strike prices that have the time value at 1% of the ETF price per month. And if we do that, we're really going to dramatically increase the odds that our trade's going to be successful. So we saw that the FDN Internet ETF, it only has to increase 39 cents or 0.7 of 1% in order for this trade to break even and start making money. So again, it only has to increase 39 cents or less than 0.1 of 1% for this trade to break even and start making money. And any increase above that 39 cents will result in a profit. And the intrinsic value of an option increases 1 point for each 1 point increase in the ETF price above the strike price of the option. So in this example with the FDN, it only has to increase 0.7 of 1% to break even, and of course that's going to have a much higher probability of success than, say, a strike price that required a 6 to 10% increase in the ETF price. So a lot of times the trade doesn't work out like you planned, and the ETF may be flat or slightly down. Well, you don't want to risk 100% of your money in that situation, and that happens quite a bit. So you want to be in a position where you have a very low break even. In this case, the ETF only has to increase 39 cents for you to start making money. So I like to focus on these in the money calls that have the time value at less than 1% of the ETF price. Here's another example of how I maximized the intrinsic value and minimized the time value. This was the healthcare ETF, symbol XLV. I bought the 45 strike call at 1082, and at the time, XLV was trading at 55.56. So I input this into the call option purchase calculator, and this option only has 26 cents of time value, and it has $10.56 of intrinsic value. So again, using that 1% rule, I minimize that time value and maximize the intrinsic value. And we can see you can still get, when you're trading these in-the-money options, you can still get a good return. If the ETF is up 10% at expiration, then I'll have the call option calculator shows us here that I'll have a 48% return. If it's up 15%, I'll have a 74% return. So you give up some of the profit potential with these in-the-money strike prices, but you can still realize a good return and still limit your risk. And you'll have a much higher probability of success with these in-the-money strike prices. And again, with the healthcare ETF, the ETF only has to increase 26 cents or 0.5% in order for this trade to break even and start profiting. Okay, so I want to just show you my real-time results, and I took snapshots of my two retirement accounts. And what I did is I highlighted the ETF trades. Some of these are, I own ETF, most are ETF options. So I just highlighted these, and in my two retirement accounts, I have $440,000 in profits trading these ETFs. So this is my first retirement account. And here's the various ETFs that I owned. This is the biotech ETF, and this lists the profit or loss for the ETFs. And I've got about $440,000 in open trade profits. This is retirement account number 2. This is a profit sharing plan. And again, I highlighted the ETF portion of my portfolio. So I trade both stocks and ETFs, and this ETF sector trading has worked out very well over the years, as you can see from these profit results. Now, the internet and biotech and healthcare ETFs that we just discussed, they've retraced recently, and they're trading near that middle Keltner channel. So they're setting up for a good buy opportunity here if you want to purchase a call option on those ETFs. Okay, so that concludes my presentation for today. And we trade ETFs and ETF options in my weekly option alert. And if you'd like to get the current profit results, which are updated daily, you can go to weeklyoptionalert.com and then click trade results, and it'll show you the trade results for each of these various option portfolios. Or you can call Brad toll free at 866-661-5664. So that concludes my presentation for today, and I'd be glad to take any questions.
Chuck, we have a few questions. Because of liquidity, do you look at open interest in ETFs, and if so, how do you assess it?
Yes, that's a good question. Some of these ETFs are really thinly traded, so I don't like to trade ETFs that are thinly traded, because what that means is there's going to be a high spread in the bid and ask price for the option. So you want to avoid those thinly traded ETFs just because the options are illiquid. So as a general rule of thumb, I like to trade ETFs that have at least 500,000 shares traded per day on average. And a lot of these ETFs are very liquid, like the biotech and the healthcare. So they're very liquid, and there's a very narrow spread between the bid and the ask. But as a general rule of thumb, limit your ETF option trading because of that bid-ask spread to ETFs that trade about 500,000 shares or more per day.
Regarding, Chuck, you had mentioned earlier in the presentation that when you do buy options, sometimes you like to ladder in. Do you have a set dollar denomination that's predetermined, or do you have a set contract denomination that's determined for your opportunities?
Yes, that's a good question, and I own about 10. I own options in about 10 different sectors, and what I like to do is I like to buy in 1/3 or 1/4 increments. So I'll wait for the stock, or not the stock. I wait for the ETF to decline in price till it gets down near that middle or lower Keltner channel. Then I'll allocate maybe 1/4 or 1/3 of my position. I'll buy it in increments. So if I was going to invest $10,000 in a sector's options, then I would buy in increments, maybe $2,500 or $3,000 per entry. That way I spread out the risk. It may take me a while sometimes to get fully invested, but I found that that's a good way to leg into these trades and reduce your risk. And another thing I do is I won't buy the next increment unless the underlying ETF is up in price since my last entry. So again, that also allows you to focus on the ETFs that are continually moving up in price, and so I'll only purchase the next increment if the ETF is up since the last one.
This is just a question a little bit off target, but Michelle and John are asking if you can come back and do a webinar on some option spreads.
Yes, that's another strategy I've been using for many years, and the spread trading is also a good way to diversify your portfolio from just having all directional trades, and we've had good success with option spreads. So yes, I will definitely make that the topic of a upcoming webinar.
All right, Chuck, we appreciate that. Obviously, we've gotten several questions on that. One last question for you, Chuck. Obviously, we have a bunch of questions that people can reach out to your support staff. But in general, do you apply the 1% rule for all your weekly options?
Yes. Yeah, I use that 1% rule for the weekly options, the monthly options, and the week options. So I own all three types of options, and I do use that 1% rule, and I found out that dramatically reduces my risk when I'm trading options, especially being that I trade in my retirement account. I don't want to take huge risks in my retirement accounts, obviously, so that 1% rule will keep me out of trouble.
Right. Okay, I'm taking back over the reins here, but for those of you that aren't familiar, Chuck is kind enough to let us archive these webinars. We will have this archived. I'm pulling up the screenshot right now of the website. But if you go to mytrademonster.com, tomorrow sometime in the morning, right here on the right-hand side of the page, you'll see webinar archives. And under March, we'll have Chuck listed there. Chuck, thanks again for taking the time. And I know you're going to have a lot of questions to answer because you brought up a lot of material people want to know. So expect your phones to be ringing. But again, thanks for taking the time to do this, Chuck.
All right. And thank you, Tom, for taking the time to set up these educational webinars.
Happy to do it. And for all of you that have questions regarding Chuck's program, feel free to, or his strategies, feel free to contact the support staff. For those of you that have any questions regarding the execution of trades, options can be a scary thing. Any questions you may have on the brokerage side of it, opening up individual joint accounts, corporate accounts, what can be traded, what can't, feel free to reach out to us, and we'd be happy to address those questions. Otherwise, again, Chuck, thanks everybody for attending, and Chuck, thanks for doing it. And Chuck's giveaway will be fulfilled tomorrow through TradeWinds Publishing. So, again, thanks everybody for joining us, and don't forget, trade like a monster. Good night, everybody.
Okay, great. Good night, everybody.